Welcome to Beyond Markets. Many thanks for joining us. I'm Esther Awuni. Today my guest is Abebe Selassie. He's a Director, Africa Department at International Monetary Fund, and today we're looking at growth prospects for sub-Saharan Africa in 2018. Thank you, Mr. Selassie, for joining us in this interview.
Of course, thank you.
Let's start with you shedding some light on some of the key highlights of the IMF's outlook for sub-Saharan Africa growth this year.
Okay, so we are projecting an acceleration in growth relative to last year. So growth for sub-Saharan Africa was of the order of 2.8% last year, and we're projecting that it will accelerate to 3.4% this year, and a little bit further in the 2019 onwards. Importantly, we're going to see growth accelerating in two-thirds of the countries in the region this year. So in general, we're seeing a pickup from the difficult couple of years that the region has been going through in the wake of the commodity price declines. However, I really need to stress that this 3.4% number that we talk about for the region as a whole masks quite a lot of diversity in terms of growth outcomes. So we still have quite a few countries that are growing at 5, 6, 7% and more. So the likes of Cote d'Ivoire, Senegal, Tanzania, Ethiopia are all growing fairly robustly at 7, 8%. What is lowering this regional average number of, and holding it well below the 7, 8% some countries are growing is the fact that you still have growth in some of the larger economies in the region, the South Africa, Nigerias of this world, still being of the order of 2%. So they've emerged from recession, but growth is still well below the levels that they were growing at in the years past. So overall then, picture is one that is much better than the last couple of years, growth accelerating, reaching 3.4%, but that average number masks quite a bit of heterogeneity in the region.
Now I know the growth across the region, I mean, many times it's country specific, but for you, what will be the key drivers, the common denominators and key drivers of growth that you see?
Okay, so this year, a couple of important influences on growth. I think the first one is that the global economy continues to improve. So growth globally has been accelerating. So that's been helpful. And with that, we've also seen higher commodity prices. That will be beneficial for those countries that are commodity exporters, of course. On the other hand, countries that are oil importers, other commodity importers in the region, and there are many more of those than our commodity exporters, those will be impacted somewhat negatively. But these two factors overall have had a beneficial effect on the growth numbers I outlined. Another external factor has been that volumes of capital inflows have been quite significant to sub-Saharan Africa in particular, at least through the first quarter or so of the year. So these global factors.
Capital inflows, what about, FDI?
FDI volume numbers are still not out yet, but what we've seen instead are, Eurobond issuances have been very high by countries in the region, but also money into the equity markets and local bond markets have been really very significant. So those have, that confidence, at least in terms of international capital portfolio type flows, has been very significant.
But around that issue of capital inflows, we've seen, especially in a country like Nigeria, but we're seeing normalization of monetary policy in developed economies, particularly with what the U.S. Fed is doing, and there are concerns that there might be some capital reversals as fund managers begin to weigh the risks of putting cash in frontier markets that they perceive may have some more risk. Nigeria, for example, we're going into an election cycle. That's an additional political risk for such fund managers. It might be temporary, but I'm thinking, is that something you also take into consideration? So
you come to the second part of our message. In terms of, so we've been welcoming very much the improvement in growth outcomes. But the second part of our message is that, what we've seen also is that there still remains quite a bit to be done to make sure that we go back to the 5-6% growth that the region has been enjoying in the recent past. And really, that's the level of growth you need at a minimum to be able to hit the sustainable development goals and the improvements in standards of living that we need to see. Now, in terms of this outlook that you highlight, going forward, part of the concern, of course, is that this, at least in terms of capital flows, types of flows you cannot rely on to help finance long-term infrastructure objectives, investment in health, education. So, they provide you some liquidity now. They provide you higher foreign exchange, but that's not the kind of flows that you can rely on. And indeed, we do warn about the likelihood that these flows could reverse very quickly, and policies, the macroeconomic environment has to be robust to potential reversal in such flows. So that's one of our policy messages. The other two messages that we have are particular attention is needed to public sector debt levels, which have been going up in recent years, particularly in the commodity exporting countries. Part of this has had to do with the fact that growth has slowed in many countries, exports have been hit, so you're seeing debt levels going up on account of that. But in many countries also we've seen public spending increases being very, very aggressive, at least relative to revenue collections. So going forward, countries need to strike a healthier balance between the much continued need to address these development spending objectives that they have, but also making sure that those are financed through domestic revenue mobilization rather than just debt financing. So the balance needs to be recalibrated. Okay.
We'll talk about debt, especially domestic revenue mobilization.
Let me finish the third item, which revolves around private investment, facilitating higher private investment growth. That is another important message, and we have some analysis about what is needed to foster that. So three messages. One is kind of this external environment is uncertain, and one that macro policies have to be robust towards a reversal in capital flows. Second, rising public debt levels, and then thirdly, there's also a need to facilitate a handover of growth engine driver from public investment more to the private sector, and reforms that are needed to facilitate these private investment.
Well, speaking about reforms, a part of your report points to the fact that African governments in this region need to take more decisive policies to help drive medium-term growth. Because if we look, even for countries that are doing between 6 and 7%, countries like Ghana, Cote d'Ivoire, growth is still not inclusive. If you look at the unemployment numbers, they're still quite high. So that divide between development and growth is there's still a wide gap between those two. So what are your recommendations? What is it that you see that these countries are not doing? They have good growth. That's not, we're not debating that. But they're still missing that link of ensuring that there is inclusive growth.
Okay. So that's a very good question. I think first point is that over the long term, over a longer stretch of, if you look at a rather 15, 20-year period, we have seen in the lion's share of countries in sub-Saharan Africa, we've seen very, very significant improvements in development outcomes. So poverty levels have been declining. We've seen infant mortality levels, maternal mortality levels, indicators that really, really matter, improving very significantly. Life expectancy levels have also improved. This is true in the lion's share of countries. What has been a bit more disappointing has been the income side of the outcomes, that we have not seen as significant an improvement in the Gini coefficient and basically income inequality narrowing. So this has been a challenge. And also, of course, given the really very large, very significant increases, many countries going through this demographic transition, and you're having an increasing number of young people entering the working age population group, the need for our economies to create millions and millions of jobs is also a big policy challenge. So here, I think, I come back to the question about private investment that I touched on earlier. A really important way to make sure that you have enough jobs to absorb all of the people entering the labor force, and with that you can begin addressing the income inequality we've seen. It has to be, making sure that, the labor intensity of growth continues to improve, and what are the policy requirements to try and facilitate that. Those tend to be very country specific. So what's needed in Ghana is different to what's needed even in neighboring Cote d'Ivoire, Nigeria. So countries have to look at almost sector by sector, or in terms of for example, labor markets, to try and see what the barriers for more labor absorption are. And our policy recommendations in these areas tend to be very country specific. In some countries, the challenge is around entry barriers, company market entry barriers. So reducing those is the challenge. In other countries, it has to do with excessive trade restrictions. So we address policies there. And yet other countries, you have exchange rates which are overvalued, which of course hinder competitiveness. So our advice is country specific, but there are a number of initiatives that we see emerging, which are encouraging and would also serve the same purpose of helping economic diversification, helping foster more employment and growth. One of these is, of course, the recently agreed Continental Free Trade Area, CFTA. I think that's a very important initiative. That's one which would help in many countries
for those who sign
expand. Pardon?
For
those who sign up to help exploit, wider markets right here in the region. Countries in Africa tend to export to each other more processed goods, more manufactured goods with each other. They trade that, and compared to trading, natural resources, oil and other commodities with Europe and Asia. So initiatives like that are also important to help facilitate
Let's
growth.
talk about infrastructure funding, or development infrastructure. Now, every year, African budgets, especially in this region, they come up with budgets and we see budget deficits. They simply do not have enough money on the capital side of things to drive that infrastructure development that they want. So, of course, they resort to borrowing. But if you look at the level of how much, for instance, taxes that they raise, it's low, VAT low. So for them, domestic revenue mobilization is quite low, and that is something you've highlighted in this report. Do you see an improvement, or what are the recommendations that you have, that you give to such countries?
Okay. So over the last 5-10 years, we have seen some improvement in the amount of tax revenues governments have been collecting. So as a ratio to GDP, we've seen an improvement of 3-4 percentage points of GDP over the last 5 years, for example, on average in sub-Saharan Africa, moving from around 12-13% to closer to 16% average right now. But I think going forward, given exactly the needs you identified, investment in health, in education, in infrastructure, continuing very high demands that there is for such investment, you really need tax to GDP ratios to increase further. Again, how you go about doing that has to be country specific, because part of it, it's going to be determined to some degree by the domestic political process.
As you look across some of the countries in the region, Nigeria, for example, we've done a lot. I know the federal government under the Economic Recovery and Growth Plan, but if you look at the tax to GDP, it's still around 6%, and I hear it's one of the lowest in the world. So it's not that it's not a lack of effort. I'm just thinking it's just not enough.
No, indeed. I mean, I think, important, for Nigeria, like our first order recommendation is the need to increase the revenue to GDP ratio closer to 15% over time. And we've been advocating for the government to adopt both tax policy and the required administrative measures to mobilize at least 1 percentage point of GDP in tax revenues per year. So that over time this will build up into a significant amount of resources to help the infrastructure spending objectives the government has, but also health, education. I cannot think of a more important policy measure for the government to take. So it is really indeed.
I've been speaking to Abebe Selassie, Director, Africa Department at the International Monetary Fund, and we've been looking at growth prospects for sub-Saharan Africa in 2018. We'll take a short break and we'll be right back with the rest of the show. Join us again. Welcome back to Beyond Markets. Many thanks for staying with us. I've been speaking to Abebe Selassie, Director, Africa Department at the International Monetary Fund, and we've been discussing growth prospects for sub-Saharan Africa in 2018. You mentioned, a couple of times private investments for the government to bring in the private cash, or at least create a conducive environment for the private sector to come play a bigger role, especially in infrastructure development. I know Nigeria is doing quite a lot in that regard, but your report still points to that in the region is still quite low. So in your opinion, IMF recommendations, what is it that these countries need to do? What more do they need to do to get that much needed private cash on the table?
So the constraints on private investment vary from country to country. So I think, in a place like Nigeria, I think the power sector deficit probably plays a really significant role. So making sure that you have uninterrupted power supply really is, the minimum that's required to attract a viable, to build a viable manufacturing sector, to facilitate higher productivity activities. So provision of infrastructure in things like power would be, I think, in Nigeria, first order priority. In other countries, the constraints tend to be policy related. So they could be things having to do with entry barriers into particular sectors of the economy. So alleviating those policy-induced constraints would be what you need to address to facilitate higher private sector investment. So, particularly with investment, the constraints have to be seen in kind of in a country-specific environment, and within even countries, sector-specific way.
What common denominators do you see?
Common denominators, I would say, are first, in many cases, infrastructure, like as in Nigeria, the absence of reliable electricity, effective ports, effective road networks has been a barrier. So that's why also countries are prioritizing investment in that area. In some countries, it's the quality of the skilled labor force. Being able to not having sufficiently educated engineers or whatever the sector needs. We also see, policy barriers like exchange rates, overvalued exchange rates being a factor in some countries. So making sure that, the macroeconomic policy environment is conducive to private investment are factors. So, this is a flavor of the constraints.
And also, in the report, I know you also talked about the importance of having cohesion between fiscal and monetary authorities. In Nigeria, I always points to Nigeria. We've seen monetary tightening. Obviously, one of the key reasons is to battle inflation, and luckily for the monetary authorities, we've seen inflation come down, I think right now 15 consecutive times. It appears we're heading to single digit. That's good, but it's come at the expense of growth. But that's another conversation entirely. But for now, it would appear that there is still no synergy between the fiscal authorities and the monetary authorities, at least for the Nigeria example. But what are your thoughts when you look across the region in terms of cohesion between fiscal and monetary authorities? What do you see?
Okay, so let me just address something you said about Nigeria, inflation luckily coming down. I'm not sure it's luck, but you always need luck. But I think deliberate policy actions the government has taken have been a very important factor in that. Look, Nigeria was hit by a really severe shock. So you had an oil price shock, of course, but the volume of oil production also had taken a hit because of the problems in the Delta region. And then, of course, there were all kinds of security issues. The economy's been working through these, multiple shocks the last couple of years. We've always argued that it was appropriate for fiscal policy to absorb some of these shocks. So the wider deficits that the government has had have been appropriate. Now, on the fiscal policy side, going forward, what's needed is making sure that you reduce those deficits, particularly by mobilizing more revenues. Now that the growth is recovered, I think this is a time to move forward with the revenue mobilization objectives that I laid out earlier. On the monetary policy side, the actions the government has taken has also been appropriate. It's important with inflation very high. That goes back to one of the things that causes that has been hindering private investment in some countries. High inflation creates a lot of uncertainty. Private investors need to know what kind of pricing outlook that is going to prevail to be able to invest. Without that, you don't know if the investment you're making is going to be profitable. So this is why getting inflation to a predictable level and low level is desirable. And of course, the other consequence of high inflation, of course, is that it tends to erode the purchasing power for the poor. People that are well off generally are able to hedge that because they can keep their money in deposit accounts, they get real returns, but it's poor people that are holding cash whose value erodes when inflation is high. So it has that importance. And we feel like CBN has done, the central bank has done a nice job of trying to strike a balance between keeping inflation interest rates high enough to make sure that inflation comes down, and as it's been coming down, easing monetary policy. So the coordination, I don't think has been as problematic in Nigeria between fiscal and monetary policy. But going forward, as I said earlier, there is a need for fiscal deficits to decline in many countries, given the high levels of debt.
Do you see the governments with high fiscal deficit, do you see a strong commitment, and then of course actually what they're actually doing to come? I mean, Ghana is a good example. The IMF program is going to end this year with Ghana. We'll talk about that, but speak to that point.
Yeah, no, the challenge in Africa, we always have good plans. It's realizing those plans that has proved challenging. So one unfortunate thing we've seen is that there's always, in the medium term in government accounts, you always see projections showing fiscal deficits reverting back to the levels that are adequate to sustain debt levels. But when the year comes when fiscal implementation needs to start, there's always often procrastination. This is not unique to policymakers in Africa. I mean, this is unique in many countries. But
because Africa is in a peculiar situation where we have structural imbalances, high poverty levels. And
now that debt levels are going up, I think it's important that we stick to medium-term spending plans. So that's another important part of the message, dialogue that we have with countries.
Let's quickly talk about the Ghana IMF plan, 918 million. It looks like Ghana has been able to get its indicators back in the green. There's talk about the country focusing more on oil. I mean, it's still a commodity, and of course that ongoing conversation about making your exports more, value-added exports and all of that. But speak to the program, how it's helped Ghana, and going forward, the kind of growth you're expecting from Ghana, and issues around fiscal deficits going forward, sustainable debt levels. That's a big problem for Ghana. Although, I mean, we've seen that come down a little, but I don't know, I just feel like it might be a problem going forward.
So Ghana came to the IMF for a program a couple of years ago when the fiscal deficit was higher than 10%. Inflation was accelerating, reserves were very low, and I think I have to give credit really to the government for pursuing a very rigorous program. They have reduced the fiscal deficit very significantly over the last couple of years. Inflation has come down, as you've seen, and the debt profile has also, both. There's been quite a bit of refinancing going on to lengthen maturities, improve the debt profile, as well as stabilizing the debt level. So it's not increasing as rapidly as it was the last couple of years ago. So really very effective macro policy implementation, and there's also been quite a bit of structural reforms that have been done in the public finance management sphere, also addressing some of the weaknesses in the banking system. I think so. There's been generally very good progress. Success, ultimately will be making sure that the debt level continues to go down as growth is accelerating.
Would you be monitoring, maybe from afar, just keeping an eye on
we have with all members of the IMF, as you know, whether you're European countries, we continue to have this policy dialogue going forward. So with Ghana, what we're looking for is, to really make sure that inflation, the fiscal deficit stays at the current level. Going forward, the government's going to need to adopt tax revenue measures, which are under considerations, as has been announced with the government. I think, making sure that those are adopted and implemented and take effect in the months going forward will be really, really key to make sure that the deficit stays at this lower level it's at, and lower level still that it needs to go in the coming years. And, we will continue to work and have a dialogue with the Ghanaian government in the coming months on these issues.
Okay, let's quickly talk about jobs. Addressing the jobs issue, unemployment. Africa has a burgeoning youth population, and many economists have described it as a ticking time bomb if governments do not find or are able to create jobs for these teeming African youth. What are your thoughts? What is your position on this issue in terms of how these governments are able to create jobs?
Okay, so this is why we emphasize the need for private investment going forward as being really a very high priority objective for policymakers. I don't think that no amount of jobs can be created by the government sector to absorb all of the people that are entering into the labor force. So it has to be in the private sector area that 80–90% of the job creation has to come. And this is why focusing on alleviating all of the constraints on private investment growth in the coming months and years in each country has to be a key focus of policy making going forward. And that's how we can be successful in making sure that the unfolding demographic dynamics will be one which is beneficial for the region as a whole. As I mentioned earlier, the challenges, the constraints on private investment are country-specific, and so I hesitate to say kind of Africa-wide policy message. But in some countries, the constraints are policy-induced ones, and that is perhaps the first one that can be tackled. I mean, it's a matter of reversing the policy constraints in terms of entry into certain sectors, that the barriers that policies have. That's easy. Things like infrastructure take time to address, including because of the financing constraint, but critical, making sure that all of government investment is prioritized and to projects which are of the highest rates of return is another policy. And then also ways to make sure that we can shift the labor intensity, look or revisit policies to make sure that we're not encouraging capital intensive investments, but rather labor intensive ones. Is also another area where work could be done.
Mr. Selassie, thank you so much for your time today. We appreciate you being on the show.
Thank you.
That's a wrap on Beyond Markets for today. Thank you so much for being a part of it. My guest today has been Abebe Selassie, Director, Africa Department at International Monetary Fund, and we've been looking at growth prospects for sub-Saharan Africa in 2018. Thank you so much for being a part of it. Remember, you can watch all previous episodes of the show on our website. That's cnbcafrica.com. You can also send tweets to our Twitter handle at CNBC Africa. You can send tweets to my Twitter handle too, at Estelle Ubutaga. From myself and the rest of the team, thank you so much for watching, and bye for now.